Imagine waking up one morning, opening your bank account, and realizing that the most important risk in your financial life was not the stock market, not inflation, not even the next recession. It was the way your own money moved through the banking system, not just the very large transfers, not just the stock trades, not just the unusual wires. Every deposit, every withdrawal, every shift from savings to checking, every transfer you make to a child, every payment you receive from someone else, every movement that creates a pattern. Now imagine you are retired. You are not speculating. You are not hiding money. You are not running a business in the shadows. You are living on a fixed income, managing the savings you built over a lifetime, and doing the ordinary things retirees do. You move money from one account to another. You pay for repairs. You help your family. You sell a car. You receive Social Security. You draw from an IRA. You take care of a medical bill. You do what you have always done. Then one day, because of one number, your account can be flagged, your money can be delayed, or your tax life can be pulled into a review you never expected. That number is $10,000. And as we move into 2026, that number matters in a way many retirees do not yet understand. I want to be very clear from the beginning. This is not about panic. Panic is almost always a bad decision-making system. Panic narrows your vision. It makes you emotional. It causes you to act before you understand the machine you are dealing with. This is about understanding the machine. The banking system, the IRS, the Treasury, and the data systems that connect them are not like the world many retirees grew up in. In the old world, a transaction was something that happened between you and a teller. In the new world, a transaction becomes data. That data can be compared against other data. It can be scored, it can be flagged, it can be routed into a system where the human being behind the transaction is not visible at first. That is the risk. Not that every retiree will be accused of wrongdoing. Not that every deposit over $10,000 is a disaster. The risk is that ordinary financial behavior can look abnormal to an automated system if you do not document it, if you do not understand the rules, and if you move money in patterns that were harmless in your mind but suspicious in the system. Let me tell you about Patricia, because her situation explains why this matters. Patricia is 71 years old. She is a retired school teacher in Ohio. She has managed her own money for decades. She is careful. She is not wealthy in the way Wall Street defines wealthy, but she is responsible every month. Her Social Security payment lands in her checking account. She has savings. She has an old retirement account. She has the habits of someone who learned early that money should be treated with respect. Every few months, she moves some money from savings to checking. Sometimes she needs to cover a larger expense. A medical bill, a roof repair, a trip to see grandchildren, a payment to a contractor, a gift to a family member who needs help. In Patricia's mind, none of this is unusual. It is her money. It is her life. She earned it, saved it, and now she is using it. But the system does not begin by seeing Patricia. It begins by seeing a pattern. The system does not know that she taught third grade for 35 years. It does not know that she never cheated on her taxes. It does not know that she is not trying to hide anything. It sees deposits, withdrawals, transfers, timing, amounts, and relationships between accounts. And if those numbers cross certain lines or appear to be arranged in certain ways, Patricia can end up on a list for review. That is how modern financial monitoring works. It starts with numbers, not with character. This is why retirees need to understand the $10,000 rule. Not because the rule is new in its original form. It is not. The rule has been around for a long time. What has changed is the world around the rule. To understand the risk, you have to go back to where the rule came from. The Bank Secrecy Act was created in 1970. Its purpose was to help the government track serious illegal activity, money laundering, drug trafficking, tax evasion, criminal networks moving physical cash through the financial system. Under that system, banks were required to file a currency transaction report when a customer deposited or withdrew more than $10,000 in cash. In 1970, $10,000 was a very large amount of money. It meant something very different from what it means today. Back then, that number could represent a large portion of a working person's annual income. It could buy things that are completely impossible to buy for that amount today. It was a threshold aimed at behavior that was more likely to be extraordinary, but the number never moved. That is one of the most important facts in this whole story. The number did not adjust as prices rose. It did not adjust as wages rose. It did not adjust as medical bills rose. It did not adjust as the cost of cars, homes, repairs, tuition, and retirement expenses rose. A threshold that was designed for a different era stayed frozen while the economy changed around it. That creates what I would call a systems mismatch. When a rule is fixed but the environment changes, the rule begins to capture things it was not originally built to capture. That is how many bad systems evolve. They do not always become dangerous because someone designs them to hurt ordinary people. Sometimes they become dangerous because they are not updated while the world keeps moving. That is what happened here. The $10,000 rule was created in a world where $10,000 was extraordinary. Today, for a retiree, $10,000 can be ordinary. It can be a used car. It can be a medical deductible and several bills bundled together. It can be a home repair. It can be an IRA distribution. It can be a family gift. It can be proceeds from selling personal property. It can be the down payment for a grandchild. It can be a transfer from one account to another so bills can be paid on time. The dollar amount stayed the same. The meaning of the dollar amount changed completely. That is where the danger begins. There are two kinds of reports that matter for ordinary people. One is the currency transaction report, which is tied to the cash threshold. The other is the suspicious activity report, which is broader, more flexible, and more subjective. A suspicious activity report can be filed when a bank believes that a customer's behavior may indicate something improper. It does not require proof that you committed a crime. It does not require the bank to know your full story. It only requires enough concern for the bank to decide that the pattern should be reported. And one of the behaviors that can trigger that concern is called structuring. Structuring is when someone intentionally breaks a larger transaction into smaller transactions for the purpose of avoiding the reporting threshold. If a person has $27,000 in cash and deposits it as 3 separate deposits of $9,000 because they want to avoid a $10,000 report, that can be structuring. The money itself may be perfectly legal. That is what many people misunderstand. Structuring is not only about dirty money, it can become a legal problem because of the way the money is moved. If the purpose of breaking the money into smaller pieces is to avoid the report, the pattern itself becomes the problem. Now, a reasonable person might say, I understand that if the bad guys are doing it, the government wants to stop them. That is easy to understand. But here is the hard part. Seniors can fall into this net without criminal intent because many seniors develop money habits in a very different financial culture. Some older Americans distrust banks, some grew up in families that kept cash at home, some prefer smaller deposits because it feels safer. Some learn from parents who survived hard times that you should never put everything in one place. Some are simply trying to manage household cash in a way that feels familiar. They are not thinking like criminals, they are thinking like people shaped by history. But automated systems do not understand family history. They understand pattern recognition. That is why a retiree can move money innocently and still create a pattern the bank is trained to notice in many areas of life. Intent matters. In automated financial monitoring, pattern often comes first, and intent gets sorted out later. That later part can be expensive, stressful, and damaging. There have been documented cases where ordinary citizens and small business owners had bank accounts seized because their deposit patterns looked like structuring. Some were never charged with crimes, some eventually got their money back, some had to fight for a long time, some were damaged even when they were innocent because the process itself became the punishment. This is a key principle. A system does not have to convict you to hurt you. It can freeze your money. It can demand documents. It can force you to hire help. It can create fear. It can make you prove what should have been obvious from the beginning, which is that the money was yours and the purpose was legitimate. That is why this topic matters so much for seniors. In 2026, the issue is not simply that the $10,000 threshold exists. The issue is that the government and the banking system have much more ability to analyze financial data than they had in earlier decades. The IRS has received more resources to modernize systems. The financial world has become more digital. Banks have more compliance tools. Data can be cross-referenced faster. Deposits can be compared against reported income. Transaction patterns can be scanned for signs of unexplained cash flow or unreported money. Again, that does not mean every retiree is being targeted. It means the system has more capacity to notice differences between what your financial life looks like and what your tax return appears to explain. That creates several concerns for retirees. Start with Social Security, pension income, and retirement account distributions. Most seniors receive regular deposits, Social Security pension payments, annuity payments. Those deposits are usually below $10,000 individually. They look ordinary because they are ordinary. But then real life happens. A retiree may take a required minimum distribution from an IRA. Depending on the size of the account, that distribution may exceed $10,000. A retiree may liquidate part of a 401k to cover a large expense. A retiree may sell an investment, move the proceeds, and then use the money for a medical bill or family support. The transaction may be completely legitimate. But if the documentation is unclear, or if the tax return does not explain the movement of money cleanly, the system can ask questions. That is the key word: explain. Modern financial life is not only about having clean money, it is about being able to explain clean money. There is a big difference. A person can be honest and still be unprepared. A person can owe no additional tax and still have a problem if they cannot show where the money came from, why it moved, and where it went. That is why records matter so much. Another concern is helping family. This is one of the most natural things retirees do. If you have children or grandchildren, you may want to help them while you are alive. You may help with tuition. You may help with a down payment. You may pay for medical needs. You may send money during a difficult period. You may want to see your family benefit from your savings while you are still here to enjoy it with them. That is not suspicious as a human matter. But as a system matter, large or repeated transfers can create questions. A gift may be legal, a family transfer may be innocent, but if the amount is large, if the documentation is poor, or if multiple transfers are arranged in ways that look designed to avoid a threshold, the innocent purpose may not be obvious. This is where many retirees make a mistake. They think the system will know they are good people. The system does not know that until you show it. That is not how data works. Data has no memory of your character. Data has records, timestamps, amounts, counterparties, and categories. If you want the system to see the truth, you have to create the paper trail that makes the truth visible. The next concern is home sales and inheritance. These are common events in retirement. A person downsizes. A spouse dies. A house is sold. A parent leaves an inheritance. An estate distributes funds. A senior moves closer to family or into a smaller home. The amounts can be large. The money has to go somewhere. When a large amount lands in a bank account, the system may not immediately know the human story behind it. It may not know that this is the sale of a house you lived in for 30 years. It may not know that the funds came from a spouse's estate. It may not know that the transaction is ordinary within the context of retirement. It sees a lump sum. If the documents are clean, that is manageable. If the documents are missing, scattered, or confusing, the situation becomes harder than it needs to be. That is why closing statements, estate records, bank statements, distribution letters, and tax documents should not be treated as clutter. They are protection. The next concern is the ordinary financial life of older Americans. This is the part that is easy to underestimate. A senior may sell a car. A senior may sell jewelry. A senior may sell furniture. A senior may sell collectibles. A senior may rent out a property. A senior may receive payments from a tenant. A senior may temporarily hold money for a family member. A senior may deposit money and send it somewhere else because that is how the family has always handled things to the people involved. It is family finance, it is practical, it is normal to an automated system. It may look like unexplained cash flow, repeated deposits, movement through an account, or possible structuring. That gap between human reality and system interpretation is where people get into trouble. So let us talk about what happens when a transaction or pattern is reported. A currency transaction report or suspicious activity report goes into the broader federal financial monitoring system. The Financial Crimes Enforcement Network collects and manages large amounts of this information. It can be used by law enforcement agencies, including the IRS, when they are looking for tax discrepancies or potential financial crimes. The IRS can then do several things. It may do nothing, and this is important. Most reports do not lead to immediate action. The system receives enormous amounts of information. Most of it never becomes an audit, an investigation, or even a letter. But some reports matter because they connect with other information. If the report shows a large deposit and the tax return does not show income or a clear source that explains it, the system may ask for documentation. If there are repeated patterns that look like structuring, the situation can become more serious. If the account activity appears to suggest unreported income, there may be an audit. In more severe cases, there can be referrals, investigations, or efforts to seize funds through civil asset forfeiture. Civil asset forfeiture is one of the most misunderstood and most frightening parts of this system. In a normal criminal case, people think the government must prove the person committed a crime before punishment occurs. But civil asset forfeiture works differently. The government can seize property if it believes there is probable cause to connect the property to wrongdoing. Then the owner often has to fight to recover it. For a person with millions of dollars and teams of lawyers, that is painful. For a retiree living on a fixed income, it can be devastating if $20,000 or $30,000 is frozen while the process unfolds. That may be the money needed for housing, medical care, repairs, or family support. Even if the person eventually wins, the time, stress, and legal costs can do serious damage. This is why the right way to think about the problem is not, am I doing anything wrong? That is not enough. The better question is, can I prove why this transaction happened if the system asks me later? That is a very different standard. It is not fair in the emotional sense, but it is practical, and in life, especially in money, you have to deal with reality as it is, not as you wish it were. Now let us move from risk to protection. The purpose of understanding systems is not to become afraid of them. It is to interact with them intelligently. There are practical things seniors can do to reduce risk. The foundation is record keeping. This sounds simple, but it is one of the strongest protections a person can have. Keep clear records of significant transactions. If you sell a home, keep the closing documents. If you receive an inheritance, keep the estate paperwork. If you liquidate a retirement account, keep the distribution statements. If you make a large gift, write down the amount, the date, the recipient, and the purpose. If you sell personal property, keep a bill of sale, a receipt, a copy of the check, or some written note that explains what happened. The goal is not to create a complicated legal archive. The goal is to make the truth easy to prove. When the truth is easy to prove, the system has less room to misunderstand you. The transaction itself is rarely the biggest problem. The bigger problem is an unexplained transaction. That is why a simple notebook can be more valuable than people realize. A spreadsheet is better. A folder with bank documents, tax records, gift notes, sale papers, and transfer explanations is better still. The exact format matters less than the habit. The habit says when money moves, I can explain it. The next protection is professional guidance. Not every tax preparer understands the financial life of seniors. Retirement income has its own rules. Required minimum distributions have their own timing. Gifts have documentation issues. Home sales, inheritances, Social Security taxation, annuities, pensions, and investment withdrawals all interact with tax reporting in different ways. A good tax professional, especially one who understands retirement income, can help you make your financial picture clear. That does not mean hiding anything. It means making sure the right forms are filed, the records match the tax return, and the story of the money is complete. A clean tax return is not just about math, it is about coherence. If the deposits, distributions, gifts, and reported income all tell the same story, you are much safer than the person who has clean money but messy records. Another protection is to avoid the appearance of structuring. This is very important. If you need to deposit or move a legitimate large amount of money, do not break it into smaller pieces. Simply because you think staying under $10,000 is safer, that instinct is understandable, but it is exactly the wrong instinct. A single properly documented large transaction is usually easier to explain than several smaller transactions that look like they were designed to avoid a report. If the money is legitimate, let the report be filed if the law requires it. Reports are not automatically punishments. They are part of the system. Trying to avoid the report can create a worse problem than the report itself. This is one of those counterintuitive principles in money. The thing that feels safer emotionally may be riskier legally. The thing that feels more exposed may actually be cleaner. That is why you need to understand incentives and systems, not just feelings. Another protection is knowing your rights. If the IRS contacts you about bank transactions, do not panic. But also, do not ignore it. Ignoring a letter is almost always a bad decision. Responding emotionally is also a bad decision. The best move is to slow down, get representation, gather documents, and answer carefully. You have the right to professional representation. You have the right to respond in writing. You have the right to ask what is being questioned. You have the right to bring order to the process. Most problems that arise from bank reporting are resolvable if the money is legitimate and the documentation is strong. But they become much harder when people ignore notices, throw away documents, guess at answers, or try to handle serious questions alone. Another protection applies to family money. Families often move money in informal ways. A child deposits cash into a parent's account. A parent sends money to a child. A grandparent helps with tuition. Someone holds money temporarily because it is convenient. These things may be innocent, but the system may not see the innocence unless the paper trail is clear. So families need to talk about how money is being moved. If your adult child is helping with expenses, document it. If you are giving a large gift, document it. If money is being moved for a home purchase, medical bill, or education expense, document it. And when amounts are meaningful, consider using checks or wires instead of cash, because they create a clearer trail. Clarity reduces risk. Cash increases ambiguity. That does not mean cash is illegal. It means cash is harder to explain. After the fact, the next protection is staying informed. Rules do not stand still. Enforcement priorities change. Reporting requirements change. Technology changes. Political pressure changes. Court cases change how agencies behave. Bank compliance departments adjust their systems. You do not need to become a tax lawyer, but you should review your financial practices at least once a year with someone competent. Ask simple questions. Am I moving money in ways that could look confusing? Do my records explain my larger transactions? Are my gifts documented? Are my retirement distributions reported correctly? If I sold something valuable, do I have proof of the sale? If I received money from an estate, do I have the estate documents? These questions sound ordinary, but they are the difference between a person who is prepared and a person who is surprised. Now, I want to address the emotional side of this. Because it matters, many retirees hear about bank reporting, IRS monitoring, suspicious activity reports, and civil forfeiture, and they feel insulted, they feel watched. They feel like after a lifetime of working, paying taxes, raising families, serving communities, and doing the right thing, they are being treated like suspects. That feeling is understandable. There is a real tension between financial crime prevention and individual financial privacy. A government has an interest in stopping money laundering, fraud, tax evasion, and scams. Individuals have an interest in privacy, dignity, and control over their own money. Those interests collide. When systems get bigger and more automated, the collision becomes sharper because systems do not begin with trust. They begin with data, if you are a retiree. That can feel dehumanizing. But the answer is not to pretend the system does not exist. The answer is to understand it well enough that it cannot easily hurt you by mistake. That is one of my strongest beliefs about dealing with reality. Reality does not care whether you like it, it rewards you for understanding it. The next issue is cognitive decline. This is sensitive, but it is real. As people age, some financial tasks become more complex. Some seniors bring in adult children, relatives, advisors, or trusted friends to help manage accounts. Some set up automatic transfers. Some give someone access to banking information. Some forget why a transfer was made or where a payment went. When cognitive decline enters the picture, the need for documentation becomes much greater. If you are helping a parent or grandparent, you need proper legal authority. A power of attorney or similar document can protect both the senior and the person helping them. Without clear authority and records, innocent help can look like exploitation or suspicious money movement that is dangerous for everyone involved. The goal is not to take control away from older people. The goal is to create a structure that protects them from confusion, scams, and system misunderstanding. Structure is not the enemy of freedom. Good structure protects freedom. Another issue is scams. Older adults are often targeted by criminals who know how to create urgency and fear. They may tell a senior to withdraw cash. They may tell them not to tell anyone. They may tell them to send money in amounts that stay under certain thresholds. They may pressure them to move quickly before the senior has time to think. These scams can destroy savings, but there is another layer of risk. The victim's transaction pattern may look suspicious even though the senior was being manipulated. That means the person can be harmed twice. First by the criminal, then by the system that sees the suspicious pattern but does not immediately see the victim. If anyone asks you to move money with urgency, secrecy, or pressure, stop, slow down. Call someone you trust. Talk to your bank. Talk to a financial professional. A legitimate transaction can survive a delay. A scam often cannot. The pressure to act now is often the signal that you should not act yet. There is also a bigger policy question underneath all of this. Seniors have enormous political power in the United States. The rules around financial reporting are not laws of nature. They are choices made by lawmakers, regulators, agencies, banks, and courts. If people believe the $10,000 threshold is outdated, that is a legitimate concern. If people believe civil asset forfeiture creates too much risk for innocent citizens, that is a legitimate concern. If people believe the IRS and banks need clearer rules about how ordinary retirees are treated, that is a legitimate concern. People can raise these concerns with representatives. They can support organizations that advocate for financial privacy and civil liberties. They can demand clearer rules, higher thresholds, better safeguards, and more accountability. But advocacy takes time. Protection has to start now. You can believe the system should be improved and still protect yourself under the system that exists today. Both things can be true. Now let us think about where this is going. The political debate around the IRS bank reporting and financial privacy has been intense and will probably stay intense. Some proposals expand reporting. Some proposals try to limit it. Some funding increases are challenged. Some enforcement priorities shift depending on who holds power. But the deeper trend is not hard to see. More financial life is digital. More data is available. More systems can cross-reference accounts, tax returns, payment records, and bank activity. More institutions are under pressure to detect unusual patterns. Technology makes monitoring easier every year. That trend is unlikely to disappear. This is why the habits I am describing are not temporary. They are not something you do only for 2026. They are part of responsible financial management in the modern age. Keep records. Explain large transactions. Avoid patterns that look like avoidance. Use professionals when the amounts are meaningful. Do not rely on memory. Do not rely on character. Do not assume the system knows your intent. Build a paper trail that makes your intent visible. That is the principle. And it is the same principle I use in every complex system. When you understand the cause and effect relationships, you reduce the chance of being hurt by events that feel random. Most people think risk is something dramatic. A market crash, a medical emergency, a lawsuit, a recession. But sometimes risk is quiet. It is a form you did not file, a record you did not keep, a deposit pattern that looked different from what you intended. A family transfer that made sense at the kitchen table but not in the database. A large cash movement that could have been explained easily if you had written down the purpose when it happened. That is why small habits matter. They are not exciting, they are not dramatic, but they protect you. Let me bring this back to Patricia. Patricia does not need to become afraid of her bank. She does not need to stop helping her family. She does not need to keep her life small because the system is complicated. But she does need to change the way she manages proof. When she moves money from savings to checking for a roof repair, she should keep the contractor invoice. When she helps a grandchild, she should write down the amount, the date, and the purpose. When she sells personal property, she should keep the record of the sale. When she takes a retirement distribution, she should save the statement. When something crosses a meaningful amount, she should assume that future Patricia may need to explain it. That is not paranoia, that is prudence. The goal is not to live in fear. The goal is to remove fear by being prepared. You worked your whole life to build what you have. You should be able to use it, enjoy it, share it, and manage it without being blindsided by systems. You were never taught to understand. But peace of mind does not come from ignoring systems. It comes from understanding them. The $10,000 rule is real. The reporting system is real. The risks around structuring are real. The possibility of misunderstanding is real. But your ability to protect yourself is also real. You can keep records, you can talk to a professional, you can avoid breaking transactions into suspicious patterns, you can use clearer payment methods, you can involve your family properly, you can respond intelligently if the IRS asks questions. You can stay informed and you can treat your own financial life with the seriousness it deserves. That is what I want you to take from this. Not fear, clarity, not panic, preparation, not resentment, control. The people who get hurt most by complex systems are usually not the people who are guilty. Often they are the people who are uninformed, disorganized, or too trusting of the idea that good intent is enough. Good intent matters morally. Documentation matters practically in the modern financial system. You need both. So before the next large transaction, before the next family gift, before the next home sale, before the next inheritance deposit, before the next retirement distribution, pause and ask the simple question. If someone asked me 2 years from now why this money moved, could I prove the answer quickly? If the answer is yes, you are in a much stronger position. If the answer is no, fix that before the money moves. That one habit can save you months of confusion and stress. And if you know someone over 60 who is still moving money the old way, someone who trusts memory cash, informal family arrangements, and habits built in a different era, share this idea with them. The rules around money have become more automated. Retirees need to become more organized. That is the adjustment. It is not complicated, but it is important. The world changed. The number did not. And when the world changes around a fixed rule, the people who do not update their behavior carry the risk. You do not have to be one of them. You know the system better now. The next move is to make your records, your family transfers, your retirement distributions, and your large transactions match that knowledge. That is how you protect the money you spent a lifetime earning. That is how you keep control. And that is how you make sure a number written into law more than half a century ago does not become the reason your retirement becomes more stressful than it needs to be.